Good day, friends, and welcome. So, in this video, we're going to be talking a lot about market makers and market takers. We're going to see what role they play in the market, what are the advantages and disadvantages of being in of this. And I hope you get value from this. If you did, be sure to like and subscribe and turn on notifications so that you get notified when I do more videos like this. Okay, let's dive right in. Now, market makers and market takers. What exactly are they? The markets are always made up of makers and takers. These two essential participants play a very important role in any exchange ecosystem. So if you're able to understand the rules that they play, it's going to help you to navigate cryptocurrency exchanges like Binance and in a large way reduce your trading fees. Makers are those who create buying or selling orders that are not carried out immediately. So they help to provide liquidity to the market because their funds or their tokens are there before their trades are actually completed. So they provide liquidity to the market. Takers, on the other hand, they fill their orders or the orders from makers, they fill them by executing immediate trades at market prices. This relationship between the makers and the takers help to form the backbone of any efficient trading platform. In this situation, we are going to use Binance as an example. So understanding the relationship between them can help you to fully understand the role that each of them play. Now let's talk about liquidity. What is liquidity? Liquidity refers to how easily it is for you to make a purchase of any coin, how easily it is for you to buy or sell without affecting the price. A high liquid asset can easily be bought and traded quickly for its fair value, right? So the more liquidity that a token has, the quicker it is in order for you to purchase it. A, a liquid market has a very high demand from buyers and also has a very high supply from sellers. This makes it easy for you to trade at fair prices. There's also what is called the bid ask spread. Now, this is the difference between the highest bid and the lowest ask price. In a very high liquid market, this difference is usually very tight. That's why it's easier for you to buy at a very fair price close to the market price. What is the role of market makers? Market makers, one of their significant roles is order placements, right? They place their orders in the order book. So market makers place orders that are not executed immediately, so they add to the exchange order book. They also provide liquidity. For the time being, before their trades are completed, they provide liquidity to the market, making it easy for trades to be completed and making it possible for there to be more trading opportunities. Also, market makers can also come in as institutions. Large traders and institutions often affect the market price because they act as market makers. Though small traders can also be market makers if they choose a certain type of order type, like limit orders or post only orders. Okay, so by placing post only orders, you ensure that the orders go into the order book and are being filled at that particular price. This gives you a guaranteed market maker status. Now let's talk about the market takers. What is the function of the market takers? One function is to consume liquidity, right? So takers remove liquidity from the market by filling orders that market makers have already placed in the order book. I repeat, they fill orders that market makers have already placed in the order book. So they consume the liquidity from market makers. Okay. And secondly, they are able to benefit from market orders. So they take advantage of market orders by buying and selling at the current prices. So this ensures that the trades are executed immediately. They also complete their trades by filling in their orders from market makers. So this is one of the primary functions to complete trades, right? So when you fill in someone else's orders on an exchange, you're acting as a taker, regardless of whatever other type you use. Market balance. So takers are essential for market function as they complete the trading cycle started by makers. If everyone is a maker, who's going to complete the trades? So takers complete these trades. Now let's talk about the fee structure between the makers and the takers. Now the maker fees are usually low in different markets, right? Usually low. So they typically enjoy low fees, sometimes even rebates, discounts because they're makers, because they provide liquidity, valuable liquidity into the platform. This helps to incentivize traders to create limit orders and then wait for it to be filled. For example, Binance um, has generally low fees for makers across all of their VIP levels. The higher you go in the VIP level, the lower fees you have to pay for each trade. So this encourages liquidity provision. Takers, on the other hand, usually pay high fees since they control the liquidity that the makers provide. When executing market orders that fill immediately, takers should expect to pay the taker fee rate. The exact fee structure depends on the exchange, but it is important to know that takers usually pay higher fees than makers because they are taking more liquidity while the makers are providing liquidity. Okay, so let's talk about the benefits of being a market maker. One of the benefits is you get to enjoy lower trading fees. Typically, in most exchanges, you get lower fees or even rebates for being a market maker. This makes it cost effective for you to trade frequently because fees can significantly impact your profits. And now another advantage is price control. You'll be able to set prices which you're willing to buy or sell, and this gives you some level of control irrespective of what goes on in the market compared to takers who usually go in and out of the market at current prices. You also get strategic positioning too as a market maker because market makers place orders at strategic price levels, allowing them to potentially capitalize on price movements intentionally without actively um, monitoring the market. They also have some level of market influence, especially large makers like institutions that significantly impact the market dynamics by providing substantial liquidity at specific price points. This enables them to potentially influence the price action at that price point with which they've provided this amount of liquidity, if you get what I mean. Okay, so advantages of being a market taker. Are there any? Of course, there are. One is immediate execution of your trades. You don't have to wait. Then when the market is fast moving, you can instantly execute your trades and you're done, right? You don't have to wait for any orders to be filled. You also get guaranteed fees. So your orders are always filled. You don't have to assume if somebody is willing to buy or sell at that price because you just want to deal at the market price, right? So um, weekends orders are usually guaranteed filled. And also there's timing opportunities too. You can capitalize on breaking news or sudden market movements and getting out of the trade or out of the market immediately. So that's one of the advantages of being a market taker. But they do pay high fees, right? So while they pay high fees, the ability to execute trades immediately can be valuable in highly volatile markets or when implementing specific trading strategies. Takers don't have to worry about their orders sitting in the order book without getting filled, right? This is particularly important during significant market events or when trying to capture short-term price movements. But there has to be a balance between the maker and the taker. And what is the importance of this balance? For one thing, it creates a healthy ecosystem, okay, an optimal trading environment for all participants involved, whether those who want to place limit orders or those who want to buy at market prices. And also, it also ensures that there's a tight spread, right? And also there's fair price discovery. And also, um, another advantage of this balance is that you get a lot of liquidity because it's easy to enter and it's easy to exit the market, right? For all traders. And so there's abundance of liquidity. Excuse me. So makers and traders have a symbiosis. They complement each other in the market. And so this is very important. The relationship between makers and takers is hugely symbiotic. Makers need takers to fill their orders, while takers need makers to provide the orders, right, to provide the liquidity and the funds, right? So strong exchanges continue to maintain a healthy relationship, a healthy balance between both takers and makers by using strategies like fee structures, platform features to encourage a certain type of trading strategy, whether as makers or as takers. So if you're able to understand whether you're a maker or a taker, it can hugely help you to optimize your trading strategy, minimize your fees while you're trying to trade crypto. Okay, so um, I hope you did get value from this, and I hope that at the end of this video, you've been able to see the difference between makers and takers. You've been able to see the advantages between making market orders, sorry, the difference between making market orders and making limit of posts on the orders, okay, and then you'll be able to see which can significantly impact your trading experience and your trading profits. Okay, so if you did get any value from this, be sure to like and subscribe, and I'll see you in the next video.